Welcome to the Teaminvest Wealth Builder podcast, where we help you build smarter wealth and make more confident investment decisions. I'm Kerry Fleming, and in today's episode, we're tackling one of the most important and often overlooked topics in investing: the biggest mistakes people make and how to avoid them. Before we hit record, we were chatting about the two main drivers behind most investing missteps: not really understanding what risk is, and the simple fact that we're all human. So today we're breaking down what risk actually means for investors, not just the academic definition, but what it really looks like when you're putting your own money on the line. We'll explore why misunderstanding risk can lead to poor decisions and missed opportunities, the most common human behaviours that trip investors up, from impatience and FOMO to letting emotions override strategy, real-world examples of how these mistakes can play out and how you can protect yourself from them, practical strategies to help you stay disciplined, fact-based, and focused on long-term results. Whether you're just starting your investment journey or looking to refine your approach, this episode will give you the tools and mindsets to avoid costly pitfalls and grow your wealth with confidence. Let's dive in. Okay, so before we started this episode, we were having a bit of a conversation in regards to some of those biggest investing mistakes. And we really came down to two kind of high-level things that drive these mistakes. One of them being not quite understanding what risk actually is. And the second one being the fact that we're all humans. So let's start with that. What understanding of what risk actually is. So I might hand over to you first, Andrew, if you can help us with that one.
Yeah, sure. So look, I think what's really important that we do before we go into that in too much detail is we separate the academic construct of risk from what we colloquially mean as risk as investors. So I think what we all colloquially mean at risk, of course, is the idea that you make an investment and end up losing your money. I mean, I think that's pretty well understood. The problem, of course, is that's not how risk is defined in academic theory or by regulators, because to regulators in finance and to academics, risk is simply the concept that the expected return and the final return, the actual result, differ. So as I like to joke, under finance theory or academic theory, a perfectly riskless investment is one that promises you 100% destruction of capital, losing all your money, and delivers it. That was not risky. You got exactly what you were told, which of course I think colloquially would say that's insane. That's a highly risky asset, right? So I think the first step is to separate those two, and then to understand where those terms come from. So under the efficient markets hypothesis, of course, there's this idea that capital markets are perfectly efficient, and so therefore prices fully reflect anything you could know, and there's no way you could invest against the market and win. That's the fundamental underlying concept of the mathematics, right? But of course, we know that's not how markets work. So under that scenario, you do arise with this amazing definition of risk and return, which we use and gets quoted, unfortunately, by asset lots, which is that higher return is required to be generated by higher risk. And it comes from two things out of that research. The first is if the market is perfectly efficient, low-risk assets must be expensive, meaning returns will be low. And very risky assets must be cheap, meaning the chance of a return is high. You must be compensated for the risk you're taking, which is perfectly rational. Doesn't tend to work in the real world, but it's perfectly rational. And then the second thing is, again, that idea of deviation from expected return. So if you expect the market average return will be 8% and your portfolio generates 16%, which would be well within the norms of what our Teaminvest members are getting, then you must be taking on at least double the risk of the market, because your actual return of 16 deviated from the expected return by a whopping 8%. And because that definition, as you probably just worked through, is bidirectional, in other words, it treats 16%, which is an 8% outperformance, the same as 0%, which would be an 8% miss, you end up with this sort of weird construct within finance and academics and within, financial services, that we force a crowding towards anemic results because anything else must be risky.
Right.
And of course, that's not how I think you and I would want to look at it. So I think with the podcast for today, we're really talking about the biggest mistakes you can make in investing. And I think that the first mistake that people can make, not we all make, other than being human, which we'll talk about in a second, is that fundamental misunderstanding of what risk really is. Because I think to an investor, not to a finance journal or a researcher, to an investor, risk is simply the idea that you lose your money.
Yeah.
I think if you aimed for 8% and got 12, you wouldn't be unhappy. And if you aimed for 8 and you got 6, you would be slightly unhappy, but you would be much more unhappy in both those circumstances if you aimed for 8 positive and got 20% negative.
Absolutely.
And I think that's the fundamental breakdown that happens, because it enables you, if you don't understand that concept in the colloquial sense, to apply it to what people talk about in finance. You can find yourself either giving away a return that you would otherwise get because you trend towards certainty. I must own a government bond and get 4% on my money because that's risk-free.
Yep.
Well, it's not risk-free. What it is the guaranteed 4%. Inflation and other things mean that may not be a good result, but it says what you get is what it said on the label.
Yeah.
So they give up return. Or alternatively, they make the mistake of thinking that I'm young, I need to grow my portfolio faster, and so what I'm going to do is invest in highly speculative things, startups, biotechs, mining companies, venture capital, because that's the only way I can get the 12 or 14% or whatever it is you're aiming for to compound over, the period of your life. And of course, we know that's absolutely wrong. You can easily get 10% plus, in fact, 15% plus, by investing in risk or less risky assets, risk low assets, if you think of risk as the chance of losing your money, not if you think of risk in the construct of expected return versus absolute return.
I should add to that, Kerry, that there's multiple ways to reduce your risk.
Yeah.
And what Andrew was talking about is the academic process and how it defines risk. But there's ways that investors can come in and reduce the risk just by understanding what they're investing in a little bit better as well.
Absolutely. Absolutely. Okay. So I think we've spoken a bit about risk. Let's move on to the other element that we discussed, which is being human. Okay. So what we're going to do today is I'm going to walk through, I think, 6 different areas that are part of being human, where we look at these are the mistakes that we sometimes get caught in. So let's start with number 1, a lack of patience. Sanji, do you want to take us on that journey?
Yeah, well, I think lack of patience is something that is so common. Normally for people, it's part of us. We just want to get things done. We want to achieve it, especially when it comes to getting money and growing our money. We want it. We want it quick. We want it now, and want to see.
We want it yesterday.
Okay, I bought in the stock. It should never go down from where I bought it, only up, right? So, and the market also caters to that, because from a broker's point of view or financial planner's point of view, or you want to create that turnaround. So as a stockbroker, we know that, okay, if people are impatient, then it's more money for us, because it means the less, the shorter the period they hold on to a stock when they buy it, they turn it over, they sell it, they buy something else and sell it, and all the while we'll clip the ticket and make brokerage on all of that.
Yeah.
So the point is, from an investment point of view, if you want to grow your returns, then having a lack of patience can really work against you.
I think we also equate being busy as being a good thing. So if we're seeing things, moving and changing, and we're buying and we're selling, we as a human, we tend to equate that as a positive.
Warren Buffett's got a lovely quote about that, Kerry. He says that if you think you can dance in and out of securities and make a profit, then I would like to be your broker, but not your dance partner.
That's right. And it comes from, when you earn a living and you go to your work and you've got a day job, or you run a business, or whatever you do, you have to be active. You have to be constantly doing things, being active. But then when it comes to your investment portfolio, it doesn't necessarily have to take the same approach. So just because it's there, you're investing with the intention of getting more money back over a period of time. So trying to be too active and trying to turn that into your day job, unless that's what you want to do as a day job, trying to turn that into your day job really can affect the ability for the returns to compound and have that be able to make the right investments, sit in those investments, and just let them grow.
Yeah, and I think Sanji touches on 2 really important themes there. There's the first question of when should you buy something, any asset? And of course, we know that the market is Having patience enables you to wait for an opportunity for the market to offer you that asset at a discount. In the same way as when you're shopping in retail, you don't want to go and pay full price for everything you buy. You'd much rather wait for a sale because you know that on average a sale comes around every, say, 6 months. And it's the same in the market, by the way. There is some piece of global news that means the market is on sale roughly every 6 months. So having that patience and waiting for the market to be on sale gives you a much better buy price. And that, of course, is one of the ingredients for a good return. The second ingredient for a good return is finding an asset that can compound for a long time, because a one-off gain of 20% pales into insignificance compared to, say, for example, 10 years of 7% compounded or 15% compounded or 10% compounded. And so that idea of being able to hold an asset for a very long time and let that eighth wonder of the world, compounding, do its work for you is, again, a criteria of patience. And there's a third element that comes in, which is probably uniquely Australian and may change if the current government makes some changes, which is, of course, that the longer you hold an asset under Australian law, the less tax you pay. So ironically, not only do you get a higher return by being patient, but you have to give less of that return to the government, which is always something that I feel a little better about.
Absolutely. That's always a good outcome, right? Okay, I think that's a good probably segue into the second one, which is chasing trends and FOMO, or fear of missing out. Do you want to take us through that one, Andrew?
Yeah, look, we're all human, right? And I think the hardest thing to do in investing is to, in the words of Warren Buffett, be fearful when others are greedy and greedy when others are fearful, because we tend to get caught up in the emotion around us. So, if a stock or an index or a sector or a market is doing really, really well and prices are always going up, take Sydney property, for example, it's very, very difficult for you to hold your ground against all of that and say, that's fine, but this is not the right time for me to invest. Yeah. And similarly, when things are crashing, and everyone's running around saying the sky is falling, it is very, very hard to hold to your ground and hold your guns and say, no, there's nothing wrong with the assets I own. You're all overreacting and I'm right. Because through most of human history, there's been very little to be gained by being the one member of the tribe who was right.
Yeah.
You made yourself an enemy of everyone else because you pissed everyone else off, and you tended to end up with no gain for being right and a hell of a lot of problem if you were wrong. You got excluded from the tribe, and if it turns out everyone was going to get eaten by lions, well, now you were the only survivor. It didn't help anyway. There was no one for you to be around, right? So that is not ingrained in our nature as humans to be able to take a considered contrarian position. There are some people who can take a contrarian position on everything, my toddler, for example, but that's not a considered position. That's just it always saying no, right? The key here is to be able to be patient, as Sanji was saying, and take a considered position to say, when the market is greedy on an asset that I like, but the market's too greedy, I'll sit on the sidelines. And when the market is fearful about an asset I would like, I'm not going to get caught up in that noise, but I'm going to take advantage of the fact that the market's on sale. And it's difficult to do.
Very difficult. And that's actually our third point, which is letting emotions drive decisions. I think that's a really good kind of feed into that one, isn't it? That standing on your own is difficult, and it's going against that normal human emotion.
Yeah, that's right. I mean, introducing emotion into decision making is great for the salespeople. So if you're trying to sell something to somebody, and if you're a salesperson, and anybody listening that's worked in sales does understand that if you're trying to sell something, make that emotional connection for the potential customer. Once you've got an emotional connection there, then you're going to have a better time trying to sell it.
Yeah.
But does that mean it's better for the customer? So as a person making the decision, the purchase or the investment, do you really want to allow your emotions to take charge? Or would you prefer to have a thought out strategic process involved in what you're actually going to invest in? So in my time in broking, I've looked after many, many types of clients, from the biggest investors in the country, the day traders, the mums and dads, everybody. I've seen them all. I've watched them trade. I see their strategies as how it plays out.
Yeah.
And over time, I also see their portfolios as to who's making money and who's not. The people that I know that have made the most money have always had a strategy behind what they do.
Yeah.
And they take emotion out of it. And they know whatever method of trading they employ, whether it be a day trader or something else, I've seen day traders, and mind you, there's many people tried day trading. There's only a couple that I've seen become successful enough. But those day traders, those really successful ones, were able to do so because they had a strategy in which they were able to turn over that stock and make money. They knew buy price, sell price, the entry point, when they cut their losses, when to take their profits. Anybody else, there's so many others that would come in and give it a go, but they get caught up with the emotion. They buy in and it goes down and you don't want to sell, or it goes up and you think it's going to keep going up. So you get too emotional about it.
Yeah, and the same thing with long-term investing, right? I mean, it's exactly the same thing. We make the mistake as humans, unfortunately, of we think that the market or the companies we invest in care about us. And they don't. I mean, the individuals there, mate, I'm sure there are staff members there who do, and they're doing good things, but the companies, the assets themselves don't, right? And so we can make this mistake as humans, and we'll talk about this, but it's all sorts of, in probably a future episode, but there are all sorts of behavioral biases that effectively mean that we as humans, once we make a decision, we want that decision to be right. And so we will force all of the evidence that we then see to conform with that belief. And similarly, if we decided not to own something, we will try and force all of the evidence to be seen through a light that will justify the fact that not owning it was the right decision. And those two elements, combined with the fact that as humans, we tend to swing emotionally from positive to negative, we tend not to be on average on an even keel, tend to mean that it's why it's so incredibly hard, as we said before, to be fearful when others are greedy and greedy when others are fearful, but also why we tend to excuse things and bend our philosophies and strategies. Sanjeev's using the term strategy, I'd use the term philosophy, but it's the same thing. We tend to bend our strategies or philosophies to justify why what we've already got is right. So, you see this all the time in long-term investing, but someone will say, I will only invest in companies whose management are honest, ethical, and capable, which is a great position to have. And then something will come out in the press that says that management team has done something that probably doesn't pass that requirement. And the same person, because they're human, who has told you, and I've done this myself, right? Yeah. Who has told you that I will only invest in honest, ethical, and capable people, will find every reason to explain why that specific piece of evidence that if it was about anyone else would show they were unethical or dishonest. But in this case was because you don't understand something that's just happened. It was justified.
Yeah. Yeah.
Well, now in the great words of, I think it was Harold Macmillan, but there's either Wilson or Macmillan about their political opponent, he is a man of many principles, and if you don't like them, he has others. And it's the same thing, right? Like at the end of the day, if you're going to have a strategy or principles and find reasons to bend it, in the end, the only loser is going to be yourself.
Following the incredible success of our standout event in Sydney earlier this year, we would like to extend a warm invitation for you to attend the Emerging Wealth Winners Conference, Melbourne 2025. This event will be held in the iconic MCG Members Dining Room. We're bringing together a standout lineup of only 7 curated ASX-listed CEOs to present the insights, the knowledge, the shared wisdom, and the strategies that help inform investors making wiser decisions on when and where to invest into. This event is sure to be jam-packed, full of the knowledge and the wisdom that you're seeking, and we encourage you to register at tipgroup.com.au. Check out the events page, and we look forward to seeing you there.
Yeah. And I guess if we step back from that, the way to not act emotionally is to not neglect the research. It's to have those solid facts.
And have a disciplined approach.
Yeah.
Just work out exactly what you're going to do, how you're going to do it, follow the process, and check yourself out. You can use friends or colleagues or Teaminvest members. And we often do it in the fund when we're looking to make an investment or introduce a new potential investment for the fund. We have some of the investment committee take an opposing view of why we wouldn't have it. So you have that discussion as to why it'd make a good investment and why not.
Yeah, and John Price talks about it a lot, or used to talk about it a lot, which is this idea of keeping a stock journal, which may be a very old school term, but what it really means is take notes about why you're doing something in the initial moment when you're being most rational about it. So that way when noise injects itself into the conversation later and emotion injects itself into the conversation later, you've got a hard copy note. Either, a hard copy can be stored on Conscious Investor as a digital form or on your email, right? But the idea being you've got something to go back to that's date stamped to say, when I made that investment, this is what I was thinking. And you can ask yourself, am I thinking the same thing now? A great example of that will be, you buy a company or an asset because you think it's got a really strong moat, some competitive advantage. And then 2-3 years later, because you like the company, it's done very well for you, might have doubled in price, value, paid you dividends along the way, something will happen that damages that moat. And as humans, our natural response is to try and excuse why that moat is not damaged, because I've got all this money out of the company already and I have a sense of ownership of it. Yeah. Whereas if you've got that note, that stock journal to go back to, you can have made the note, for example, that, this is the moat. And if this risk triggers, then this is what I'm going to do. I'm going to sell because, materially weakens the company. And that doesn't mean we will then listen to our former selves, but it at least injects a little bit of rationality back into the conversation rather than the emotions in the moment. Because we know that the way the human brain works, right? We make decisions almost on everything on emotion. And then we do a process called post-hoc rationalizing, which is where we go back and find reasons why to justify our emotional decisions. So we look for rational information for research that proves that our gut feel was right, which makes us feel very comfortable, but is a recipe for bad decisions, whether that's in your relationship, whether it's in your family life, whether it's in business, and certainly in investing as well.
And I suspect the longer that you hold a particular asset, then the more emotional connection you have with it. So the harder that decision becomes.
And the more the product that they make appeals to you. It's a silly thing to say, right? But if a company makes a product or service that you like, you either want more of in the world or you personally use and enjoy, it is amazing how you will end up finding, if you're a human like me, that you will justify poor performance of the asset, the company, because I like the product.
Yeah.
And vice versa. If I hate a product, and I've done this one, you will find reasons why the company that's making a monster out of that product because everyone else likes it is completely wrong. And really, you are the right one. That's a bad product, and therefore the business must be bad. And they're two separate things. And I know, Sanj, you've done a podcast already on that idea of separating the product from the business.
Yeah.
But it's hard to do, and it's particularly hard to do because we're human.
Yeah.
Can I give a practical example for this? Because I've been not struggling, but I've been conscious about an investment that I have in ResMed.
Mm-hmm.
Now, ResMed, I got in with the Ozempic saga and the price tanked. I was able to get in at a great price. I've made a good money out of it. Quite happy with it. Their sales keep growing. They keep performing well. But what I do notice is whether it's Ozempic or the GLP-1 drugs, that's one set. There's other sleep apnea drugs that are being developed and tested and trialed. So one thing I've got to acknowledge is that there are competitors trying to breach ResMed's moats.
Yep.
And I don't think anyone's done it yet. I don't think ResMed's had their moats breached. I think they're quite safe at this point. But it is just a simple acknowledgement that it is that process is happening. People are trying to breach it. Whether they can stand against it or whether they do end up breaching, we don't know. But at this stage, it's something I've got to consciously keep an eye on and make sure I don't get caught up in that whole attachment to ResMed because it's made me so much money. I've got to keep a fresh mind to say, okay, if the moats do get breached, this is where I bail out.
Absolutely. And the stronger the moat, just to that point, the greater the risk if it is breached. Obviously, they're harder to breach, but if it is breached, the damage is catastrophic. I'm a history nerd, right? But the greatest defensive formations until World War I were the Theodosian walls of what was then Constantinople. And of course, Constantinople stood with the Theodosian walls against attack almost every 5 years for about 1,000 years, and no one breached it until one day in 1450-something, a certain Turkish general breached the walls with cannon. And since that day, the name of that city has not been Constantinople, it has been Istanbul, and it has been the capital of Turkey. So from that idea that the Roman Empire could fall finally, or because the walls were breached once. It's important to understand. But I think to that point where Sanji was coming back on the practical example, the easiest way to test and to get your emotion out of it is to look at data.
Yeah.
And so what I would say is if a company has had, for example, very strong return on equity for many years, like ResMed, the fastest and easiest way we will see that that moat has been breached is not an article in the AFR or an article in the Australian. It's going to be the day that that return on equity starts to decline, because it won't go from 40% to zero overnight. It's going to go from, unlike the walls of Constantinople, right? It'll go from 40% to a new competitor eating some of its lunch at 35. And then the next year, because these things take a long time to ramp up, maybe 32, then 30, then 28, then 25. So again, as an investor, unlike a defender on the walls, you actually do have time to see these things being breached and take action, but you have to take your emotion out of it. Because if that ROE does start to decline materially, not because equity increases, but because returns actually drop, always check that. Then at some point, you've got to say on that journey, hang on a minute, these walls have been breached.
Yeah.
And that's the challenge, of course, that Kodak had, many years ago with digital cameras, right? Is Kodak accepted, effectively invented digital cameras, said this would hurt our film business, put it in a drawer and shut it down. And it took the market probably 15 more years to come up with digital cameras without Kodak. But every year for those 15 years, Kodak's returns declined as their market share declined, as they refused to get into digital cameras. And eventually, of course, Kodak was worth a fraction of what it had been at its peak. As an investor, the good news is you had many years and many opportunities to get out without losing that much money or money at all. Yeah. But you have to at some point get out. Just because the roller coaster has a steady drop, it doesn't mean you're still not coming down, right? So you've got to be aware of that and take the emotion out of it. And it's particularly challenging when it's an asset you've held a long time, as you said, Kerry, or a product that you like, or people, if it's ones that you trust and like, particularly if you've got a personal connection or you feel you have a personal connection to.
And I think there's a couple of things that we've hit on with that. We've spoken a couple of times about noise and cutting out the noise, which is one of the values that we work to. We also talk about factfulness, and the fact that we make decisions on factfulness as opposed to being led by emotion. And that's another one of our values.
Yeah, absolutely. I mean, as we just said, the easiest way to get your emotion out of it is have a clearly defined series of rules and goals and look at the actual data and see how do they stack up, which is all the concept of being factful.
Absolutely. So second last one, timing the market. Now, you alluded to this with your ResMed example, and you were able to time the market. But what's the mistake that people make in regards to trying to time the market?
I think what they're trying to do when they time the market is pick the very bottom or the very top of a price in the market. I think if you're going to be an investor, trying to pick the bottom and tops, it's never going to happen. And as I said, in my career, you never see anybody consistently able to do it. If you do, it's a fluke, right? And it's a one-off. But what you want to do is find a fair value for what you want to buy and say, okay, you've already identified it's a great company. Now find what's a fair valuation on it. And we do that by looking at the PE and say, okay, this is what it'd be trading at. This is a fair valuation. I'd be prepared to pay to be an investor in this company. And when it gets to that valuation, buy some. If it gets quite below that valuation, buy more.
Yeah.
Right. But
I think the challenge is, and it's funny because you mentioned it, right, is this idea in stocks that because we can see, or other assets that are regularly traded, because you can see a market price all the time, you can get very caught up on, did I pay the bottom or not? And of course, that's a recipe for disaster. And if you use the analogy I was using before about, a retail shop being on sale, we've all had that experience, I'm sure, where you walk past a shop that you've just bought something at and they've now got another sale that's bigger than the sale that you just took advantage of. And it hurts. Let's be honest. It does. It really gets you emotionally. But the reality is if you bought the asset, the shoes, the shirt, whatever it was, that you wanted at a price that you thought was a good price at the time, does it matter that they went on sale again later with the bigger discount? No, but it feels emotionally important, right? And it's the same thing in the stock market. So if you bought a great asset at a reasonable price, and we use the word reasonable price for a reason, right? At a reasonable price, a price you were happy with given the risk you saw in that asset and your own circumstances, then the fact that someone else got a better deal can hurt emotionally, but it makes not a single jot of difference to your long-term happiness and your long-term success. The challenge, though, is to separate that emotion of seeing it on sale for a bigger discount from the reality, and vice versa in terms of selling. If you sell an asset and you later on see, because you didn't like it, for whatever reason you fell out of love with it, and the later on Mr. Market turns around and says, well, I would have paid you more, it hurts.
Yeah.
But it hasn't changed anything. You got out of an asset that you didn't want anymore at a price you were happy to receive. Who cares? But it hurts.
It does.
It's a classic thing about, if you take it into houses, you sell your house, 5 years later, the person you sold it to sells it again. The market has gone up and they get, say, 20% more than you sold it to them for. And boy, do you have that conversation at home of why didn't we hold out for a higher price? Well, that's not the way you can look at the world. What you've got to say is, did the price we get was reasonable? What did I do with that money? Because there's an opportunity cost. I may have bought something else that's done much better than that 20%.
Yeah.
And if not, what can I learn? But timing the market is a recipe for disaster for everyone except your broker, who will, benefit from your constant in and out as you struggle to deal with the emotions of it.
So it's an interesting point about the houses, right? So if you go to buy a house and if it's your own property, it's a much more emotional decision on it. And what tends to happen is, say, easiest illustration is if it was an auction, you're the highest bidder. So immediately after you've paid as much as you wanted to pay for that place, if you turned around the next minute and said, I'm selling it now, you're only going to go to the next highest bidder, which is already less than what so you have overpaid for it.
Yeah, that makes sense.
Now, when you go to the market, you don't see that same thing. And in the example of a house, it doesn't then get revalued 10 minutes later, half an hour later. It doesn't get revalued every day, 1,000 times a day over the next, 5 days a week for the whole year.
Yeah.
Right. So because you don't see that with that investment or that purchase, and it's an emotional purchase, there's a lot more ways we can justify it. See, if it came to an investment property, and if you're bidding on it for the sake of an investment, you take a much more rational mindset to it.
Yeah.
And you say, okay, it's only worth it if I buy it at this price. And then you may pay a little bit more, but then generally, as an investor, you'd be happy to step out.
Because you haven't already designed the kids' rooms and what you're going to do with the backyard.
Exactly.
All of those
You
things.
haven't had that emotional connection to it. But you've realized, okay, this is a great investment for XYZ reasons. This is my rental return or whatever you're going to get your returns on. And then you've identified the price. Apply a similar process when you're investing, not the same process, but a similar process that you will at least have a process.
Yeah.
That's probably the first part of it.
And I think Sanji makes two really, really valid points there about the difference in the way we look at, for example, buying a house and buying a stock. But in reality, the same thing's occurring. We just justify it differently. So almost by definition, if you're a value investor, a long-term investor, when you buy a stock, it will go down straight after. And it does that for two reasons. One, as Sanji just pointed out, rightly so, the person who bought at any moment, by definition, offered the best price in the market. So if you bought the stock, you were, for a fraction of a second at least, the person willing to pay the highest price out there. So rationally, the odds are that the next couple of buyers, if there's a motivated seller, are going to be paying less than you.
Yep.
So it's going to look like I bought today and it was down tomorrow. You don't see that in a house because you're not putting it straight back on market. So that same effect is not emotionally hurtful in a way that it's emotionally hurtful on the stock market, but it's no different, right? It's the same reality. You bought it because you were prepared to pay more. By definition, therefore, if it went straight back on market right now, it would sell for less. So as a long-term investor, you must assume rationally that most times when you buy a stock, it's going to go down rather than up. The second thing is, if you're being fearful when others are greedy and greedy when others are fearful, the odds are that your moment of greed is going to come when more people are fearful than greedy. And given that the stock market is just simply aggregating buys and sells, greed and fear, if there's more fear in the market than greed, the odds are it's going to continue to go down. There's more sellers than buyers, right? So even though you paid a price that you were very greedy about and very happy with, the odds are someone else on the other side is still panicking and going to sell even more stock at a cheaper price. Now that raises the obvious question of, well, wouldn't there possibly be a way to time the market better to get in towards the bottom of that. And the problem with that, of course, is that, well, absolutely not. Because unless you can somehow work out what all the emotions of everyone else is, how would you know? And then secondly, you have a problem, which is opportunity cost. And why I bring that up is I think so often we can look at a price chart, whether it's for a house or a share price or whatever, and say, well, if only I'd bought there and sold there, pick the two biggest points, right? But of course, there's a time period. If those points are 6 months after you made a decision, it's not just that you might have got a better price, but it's what did you forego in that 6 months for having continued to hold on, sitting on the fence and getting splinters. And so, of course, you get two scenarios. One, you wait so long, you miss out.
Yep.
We've all seen that in all sorts of assets in life, relationships. But the other one as well is, let's say that I sold an asset and put my money into something returning 15% per annum. Then a 6-month wait has cost me 7.5%, half of 15.
Yeah.
So unless the better price is 7.5% better, I'm still better off having made the decision 6 months earlier.
Yeah.
And same thing with buying. If I buy and I paid 10% too much, but it's a long-term investment that compounds for longer, that extra 6 months of compounding 2 years down the track, 3 years down the track is probably worth way more than the difference in price that I avoided in the beginning or I missed out on in the beginning. And we forget that because we look at a graph and go, but I could have been better. Well, we all could be better. It's life.
Yeah, I mean, as a broker, I get the same. I get that a lot because I often had to execute trades for people, and the task is usually execute a large order below the market VWAP or the volume weighted average price. So you want to try and get it at the bottom for whoever you're buying the stock for. So by training, by definition, I'm always trying to work out and pick the bottom. But there's no way you can actually pick the bottom. You just got to keep, you buy in at a good price, at a fair price. And whenever you see it low and low enough that you're happy to buy it, just pick it up.
Yeah.
Yeah.
Oh, no, that sounds really good. Okay, so we've gone through quite a bit today. So we've gone through things like chasing trends and FOMO, letting emotions drive decisions, lack of patience. There is one more that I'd like to touch on before we close up today. And that is cutting the flowers and watering the weeds. And Andrew, I'm going to hand over to you to explain that one.
Sure. I love being human, but I wish sometimes in my investing decisions I was a little more robotic because it would make life easier, right? But there's a tendency we all have, and it was coined beautifully by Benjamin Graham and Warren Buffett, of this idea that we water the weeds and cut the flowers. And what that really means, it means when you're looking to take some cash off the table for your investment, you want to buy something else, whatever that is. And I presume most of us are investing because we have a reason to use the money. We're not doing it purely for fun, right? There is a very human tendency to look at what's up in your portfolio and say, well, this one I've made 3 or 4 times my money on. That's the one I'm going to sell. And this one that I haven't yet made a return on, or as much as I wanted, I'll hold on to it because it's going to come good. And of course, if you do that once, you could be right. But if you start doing that regularly, and that means, you may have need for capital regularly, then very soon you're going to end up with a portfolio full of weeds with very few flowers, because all of your best assets, the ones that are growing at the fastest rate with the highest degree of stability, achieved with little or no debt, with great, honest and trustworthy management, they are most likely over time to be the ones that are up the highest. So you're going to sell them. And the ones that are missing one or more of those ingredients are most likely to be the ones that haven't performed. So in other words, you're going to be left with the portfolio least likely to perform in future, and have taken off the table all the things that were going to be most likely to give you a good result. Now, obviously, sometimes we need money off the table. So what should you do? Well, invert it. Firstly, try and cut the weeds. Get rid of them. If you need some cash and there's an asset that isn't looking very good, I don't mean on price, but I mean the performance of the business isn't looking good.
Yep.
Now's the time to get out of the emotion, hoping to get back and get even and sell it. Take your 30% loss, whatever it is, get out, have the cash, enjoy the tax refund, and most importantly, be left with a portfolio of your best performers, not a portfolio of your worst performers. But it's really, really hard to do, because I think as humans, we all exhibit a little bit of the trait of what I jokingly call get-even-itis. This idea that, I must get back the dollar value that I spent on this asset. I bought this house for X, or this car for X, or this stock for X. That's what I have to sell it for.
Yeah.
And of course, if it hasn't been a very good investment, there's been problems with the house, or the market's gone down, or, the management has changed, or the performance wasn't what you wanted, the odds of you getting your money back are low. The only way you're going to get your money back really in nominal terms is wait long enough for inflation to erode the purchasing power of that money by enough that you can get it back. But that's a bad investment. That means you've just gone backwards. You've just gone backwards slowly, right? You're far better off just cutting your losses and saying, look, I got it wrong. I'm human. I'm not going to make all my decisions right. This asset isn't performing. I need X amount of money to do what I want with it. And I'm going to sell that and keep these great performers. It's a very big human challenge to do, because normally you'll look at the portfolio and go, geez, I put, let's say, $100,000 into that one. It's worth $2 million now. What if I just take a couple $100,000 off the table? Well, yeah, but that's your best performing asset. The overall returns of your portfolio are now likely to shrink. The only exception being, of course, is if the reason that one is up so high is not because of the performance of the business, but because Mr. Market is offering you a stupidly high price for it. And that idea that someone's come knocking on the door of your home and said, I'll buy the house. And you say, well, I wasn't selling. They say, well, don't you want to hear what I have to offer? And make you an offer that you can't refuse. I mean, in that case, you might sell, but that's not because you're wanting to get even or get out. It's because that price was just, astronomically too high and stupidly high. But for the majority of times, we don't get that opportunity in the market. Normally we're not making decisions because, in the immortal words of Kerry Packer, you only get one Allen bond in your lifetime. We tend to be more likely to be making decisions because we want the money, not because the market is making us a crazy offer. Yeah. And in those circumstances, look at your portfolio and make sure that you avoid that human mistake of cutting the flowers and watering the weeds. Get rid of the worst ones.
And I think with that one, it really shows how all of these kind of, I guess we call them mistakes, investing mistakes, they all tie together. It's very much about having a look at the research, understanding the underlying investment, having a methodology that you follow, cutting out the noise, and trying not to be led by your emotions.
Absolutely.
Is there anything else that you would like to add for our listeners today?
I think only if you want to find out more about how we do that at Teaminvest or at TIP, feel free to reach out. We're always happy to share, and we'd love to see you, I'm sure, as one of our members learning alongside us and taking advantage of the collective wisdom together.
Absolutely. Well, thank you both for your time.
Thank you, Kerry.
The information contained in this podcast is of a general nature and is not intended to address the objectives, financial situation, or needs of any particular individual or entity. It is provided for informational purposes only and does not constitute, nor should it be regarded in any manner whatsoever as advice. It is not intended to influence a person in making a decision. No one should act on such information without appropriate professional advice after a thorough examination of their particular situation and needs. Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.